It's a massive week for financial markets. Mag 7 names reporting. We've got tariff news culminating in the deadline on Friday. Of course, alongside that, we've got the FOMC meeting on Wednesday. But at the back end of the week, alongside that tariff deadline, we do have the US jobs report, and the precursor to that is the core PCE price index, which is the Federal Reserve's favorite inflation metric. So plenty for traders to sink our teeth into. We're going to go through a whole raft of charts and graphs and then take you through what this could mean for markets. As ever, first and foremost, we're going to look at exactly what markets are expecting. And we can see here, I'm just sort of kicking things off on Thursday. We also have data on Tuesday, Wednesday. You know, we've got a lot coming over the course of the week. Of course, we've missed out here the likes of the JOLTS number, the likes of the ADP figure, but I could barely squeeze this lot on as it is. So we're just going to look sort of beyond the FOMC meeting and see exactly how things shape up from there onwards. So Challenger job cuts, you could see the possibility of a jump in terms of that figure. The more important stuff is going to come after that, though, on the Thursday, which is the core PCE price index expectation that we rise to 0.3 on the monthly figure. Personal income and personal spending also, I think, are going to be really key. A keen insight into exactly how the US economy and people are faring under the weight of tariffs. Of course, worth noting, this is for June. Then we've got the initial jobless claims, a weekly figure, and not necessarily going to be a massive mover. Then the core PCE price index, the year-on-year figure. So like I said, 0.3 for the monthly figure. That is expected to help things tick up to 2.8 on the annual metric. In terms of Friday, like I said, it's the jobs report, and we have an expectation that we see weaker payrolls, that we see higher unemployment, we see average hourly earnings largely under control. And we'll go through this, but ultimately we've seen unemployment under control. We've seen payrolls generally beat expectations time and time again over recent months. So it's just a question mark is like, do we finally start to see things roll over, or does it not happen? And beyond that, it's worth noting that we close out the week with these ISM numbers, the ISM manufacturing PMI. Worth noting, if you're looking at different economic calendars, I generally use trading economics. One part of it is that it splits things out, gives you more granular detail for some of these numbers. So if you just want to see the simple top level stuff, which sometimes I want, I'll go into something like Forex Factory. If I want to see the more granular detail, I'll be looking at the likes of trading economics. And you can see exactly that here, right? You've got the non-farm payrolls figure. Then you've further down got the breakdown in terms of private, manufacturing, government. So it really sort of gives you an idea of exactly where those numbers are coming from. And again, that's something we'll sort of get into. But that ISM manufacturing PMI figure, that the key parts will be, you know, the likes of the prices element in particular, in terms of whether inflation's feeding through into the manufacturing sector and the employment numbers. But certainly, you know, if you look at that ISM manufacturing PMI, 49 was the previous figure. Things don't look all too bad. But if you look at the breakdown, the employment figure and the new orders figures are awful. And then the prices figure is massively elevated. That's not a good thing, right? That's sort of stagflation in one single report. So certainly that's a really interesting one to be following, and we'll sort of touch briefly on the ISM prices paid element a little bit later on. So first and foremost, of course, the Federal Reserve has a dual mandate. It means that they're not necessarily just targeting inflation, but they want to keep inflation around 2%. They want to see unemployment under control. They don't want to see a surge in terms of the unemployment rate. Now, what's expected this time around? We have got the core PCE price index coming out on Thursday. We've got the jobs report on Friday. So the two parts of the dual mandate are released over the course of 2 days. Will we see inflation rear its head or remain low? Will we see unemployment start to surge? Well, like we've said, markets are expecting the core PCE price index to rise. That could hold off the need for rate cuts. And then unemployment expected to rise. And that could potentially make people think that they might need the rate cuts. So both of them pointing towards the opposite directions, essentially. But also they're kind of tentative moves. So you wouldn't necessarily just sort of make your judgment on that one small adjustment. So if you're looking at the inflation metric, one way of looking at it here is If you're looking at headline numbers, I would generally take the headline CPI number, not the headline PCE. Whereas if you're looking for the core figure, you'd be looking at core PCE. So I've kind of joined the two together, and you can sort of marry things up on a monthly basis. I think monthly is a good way to be looking out for this. Notably, if you look back to this time last year, you can see the figure that we're looking for here is the June figure. The June figure expectation is that we're going to see 0.3 for the core PCE, which is the sort of orangey yellowy bars in the middle. So that June figure needs to be filled in. The recent CPI figure came in relatively hot. You can see that figure above the horizontal line, which is essentially the line we need to be sticking around to try and get back down to 2%. So last year, we can see that the figure on the left-hand side of the chart is roughly sort of a bit above 0.2. So 0.2 from last time around. Market's expecting 0.3 this time around. And that sort of replacing the 0.2 with 0.3, that's what leads to the possibility of an uptick in terms of the core PCE price index, which is 2.7, but market's expecting 2.8. Now, if you're looking at the sort of trajectory of inflation, we can see here at the top, we've seen a bit of a resurgence in terms of CPI, not massive in terms of PCE thus far, but certainly, you know, that they're starting to turn gradually higher. It's notable that if you're looking for a time where we'd see disinflation coming into play, we'd be looking at sort of base effects. And the base effects element here is basically when we're stripping out the figure from a year ago and replacing it with a new one, you know, how does that change the year-on-year figure? So, for instance, you might have a figure from a year ago that was particularly high. Let's say you had a month-on-month figure of 1% a year ago, and that's being stripped out. Then this monthly figure comes out and it's 0.4. 0.4 is elevated, but it's still well below the 1% from a year ago. And therefore, the year-on-year figure drops sharply, maybe 0.6%. And markets think, great, look at this massive disinflation that we're seeing. But that's not disinflation. That's actually 0.4 in a monthly metric. So it's key to look at the sort of annual figure. Yes, that's going to grab the headlines, but look out for what's happening on a monthly basis. And you can see here the latest CPI figure did start to turn towards the upside on a monthly basis. Will we see the same kind of thing for the core PCE? That's what markets are expecting. It's a tentative move higher, but it is a gradual resurgence that's happening in terms of prices according to that. Now, if you look at different ways of looking at this, but you've got a number of different surveys that essentially provide us with a sort of precursor of how people are feeling on the ground, right? And so the ISM numbers, and I've highlighted the fact that the ISM manufacturing PMI is already on Friday. The ISM numbers or reports have these prices paid elements within it. And so if you add a 6-month lag and you overlay it with inflation, you can see here that generally it sort of highlights that those people within the ISM reports will tell you that prices are going higher prior to inflation really turning upwards. There's a number of different sort of ways to look at this, but ultimately in this instance, I think the fact that we're seeing many businesses knowing that tariffs are coming and stockpiling ahead of time means that they can hold off for a period of time. Maybe they see their sort of margins cut a little bit over the near term. Maybe they sort of wait off and try to stave off any price increases on the consumer until they really have to. And they're hoping there's going to be some sort of trade agreement coming into play with Trump, which might happen. And it has for many, but of course we still have that sort of 15% tariff, which is a sort of average tariff we're seeing for some of the likes of Japan, the likes of the Eurozone and the like, or European Union. Still 10% for the UK, 19% for Indonesia. So, you know, the question mark here is, are we going to see inflation turn upwards in a way that we have already with the prices paid element for the services and manufacturing PMI as well? You can see here that actually, if you look into the latest CPI metric, there are a number of areas where we have seen a resurgence in terms of inflation pressures. Notably things that are getting imported from the likes of China and like video equipment, men's shirts, women's dresses, audio equipment, men's footwear, major appliances, toys, sporting goods, furniture, all elevated according to sort of historical norms. So we're starting to see tentative signs. It's not to say that we're seeing it across the board. And so really sometimes you can look at inflation gauge and think, okay, it's not necessarily too bad. It's not rose by any sort of really significant degree. But sometimes you need to dig a little bit deeper to be able to see that. And you can see in terms of the monthly inflation figures, the core CPI and the headline CPI, both on the rise quite significantly over the June month. So are we going to see something similar? That's what markets are expecting. 0.3 expected for that core PCE. Now, in terms of some other surveys, of course, I brought up the ISM numbers, which I've kept on here, but I've also got a bunch of other ones which are play a similar role, but they've got more of a focus on the manufacturing sector. So the Philly Fed, which is at the top of this, that Philly Fed prices paid. We've got the Empire State prices paid. Again, that is the second in line here. We've got the Richmond Fed. That's not necessarily as elevated, but certainly sort of popped a while back. The Richmond prices paid on a 6-month annualized basis, that has sort of pulled back a little bit more recently. So a number of different metrics here where you can see businesses really reporting the resurgence of price pressures. And I guess the question mark is whether that's going to be lasting or not. Now, one other survey I just wanted to highlight was the Michigan Fed inflation expectations read. They give us the 1 year and the 5 year, and we saw a major pop around that Liberation Day announcement. And so these are inflation expectations. And so you can see that there has been a significant drop off since that Liberation Day peak. So inflation expectations are actually easing. And with each trade deal that comes, yes, we see tariffs coming with all of them, but it's not a given that all of those tariffs will be passed on. In terms of the job side of things, right, so here's the non-farm payrolls figures, but split out according to the different parts of the US economy. One part that I'll touch on in a sec is exactly how the latest figure really was split out. So the last, I think, 3 months, we've expected to see a sharp decline in terms of payrolls, or markets have, and we haven't seen it. Instead, we've seen payrolls remain relatively elevated between the sort of 100 to 200K mark. Notably, when we're looking at the latest figure, you can see that things have shifted up a bit, right? So you can see that gray zone, that education and health services, coming off quite significantly. But when we're looking at the pink one, which is government hiring, we saw a sharp uptick in terms of that. And you can see that here, right? So private hiring, which are the bars, the histogram, down sharply and reversing that trend that has been playing out of higher private hiring over the course of 2025 thus far. Meanwhile, we saw that sharp surge in terms of government jobs. So not necessarily what you want if you're looking for the health of the economy. Generally, you'd want to see lots of private jobs, not necessarily a reliance on government hiring. ADP figure is going to be interesting, but also people realize it's increasingly irrelevant when it comes to predicting what's happening in terms of the headline figure. You can see here that the gap between the ADP figure and the headline number just continues to grow. The latest one, 180K. You can see here in terms of the orange yellow line, I don't know which one it is, but essentially to me it's kind of orangey. But anyway, on the top section here, that's the payrolls figure, right? And it's remained elevated. I say elevated. It's just been stable. It's been a nice sort of 100K to 200K mark in the middle there, sort of 150, that kind of area. And then you look at what's happened in terms of ADPs, right? So the ADPs have dropped off and now in negative territory. And so, you know, what happens is we see these awful ADP numbers. Everyone starts to get fearful that we're about to see a collapse in terms of headline payrolls numbers on Friday. And it just doesn't happen. Payroll stays elevated. So you see quite significant volatility, and it will be very interesting to see if we see the same kind of thing this week, where markets really react to that payrolls, the ADP figure, thinking that's a precursor to a similar kind of thing on the Friday, and it just doesn't happen. So yes, we're expecting to see weaker non-farm payrolls, but you know we've been expecting that for months, and it hasn't come. Another element of the jobs report is the wage growth figure, and I just think this is under control now, quite frankly. You know, I've added the 3-month annualized figure, compared it to where we were pre-pandemic, that sort of gray band. That's exactly where we are at the moment. So I don't think it's problematic. I don't think it's indicative of sort of resurgence in terms of underlying inflation pressures. But then I guess the problem right now in the US would be sort of imported inflation, rather than inflation born out of elevated wages. But certainly it becomes a cycle, right? With higher prices comes the demand for higher wages, comes higher input costs for businesses, and they have to increase their prices, and it's kind of a virtuous cycle. In terms of market expectations for this week, of course, we're not expecting anything. But when it comes to sort of looking further out, we're expecting to see a rate cut in September, even more confidence that it's going to come at least by October. Then by December, markets pricing in a roughly 64% chance that we see a second rate cut. So 2 rate cuts expected for the remainder of this year. That's not necessarily bad going, quite frankly. But then when you look into the sort of following year, you look at 2026, and the sort of base case scenario is like a rate cut every few meetings. So you're talking about like 1 rate cut every 3 months or something. It's not great, and it's the kind of thing that I think is likely to increase. I think we'll be seeing additional rate cuts coming into 4, because I think that inflation, yes, we'll see a sort of short-term move higher, but I don't necessarily think it's going to be the kind of thing that the Federal Reserve will forevermore say that they're going to sit on their hands. And so that's why these inflation numbers are really important. They're certainly, key to market sentiment over the near term. And if we do start to see a notable resurgence in terms of inflation, then you're pointing towards a possibility of the Federal Reserve sort of holding off, maybe not acting in September. And the question mark from there is like, where are we going from here? Will the Federal Reserve need to see inflation actually come back down to target, or are they going to be willing to essentially look through a short-term blip in terms of inflation pressures, which many members have cited as being a distinct possibility. In terms of the sort of chart, so this is the chart for the Dow. I just wanted to cover it because I know it's a popular market for traders, but certainly it's been an underperformer when it comes to US indices, the likes of the Nasdaq leading the way, the S&P 500 after that. And part of why the Dow's underperformed is because one of the major components is the somewhat unloved, recently anyway, Apple. And Apple shares have been tumbling, and so that weakness in terms of Apple shares has really provided a drag on the likes of the Dow. But nonetheless, the Dow now back up around that peak that we have here, December 24, February 25. Now we're back at it again. The question mark is, can we break through this time around? Let's see if we've got any sort of decent trend line support coming into play here. So roughly, we can just draw it there. So you've got the possibility of sort of trendline support coming into play. You've got this, I'm hesitant to draw on the top end of this fib because I don't know if this is a retracement coming from here, right? So it might not be accurate, but if we were to respect resistance, then you'd be looking out for sort of trendline support to potentially come into play, Fibonacci support to potentially come into play. And beyond that, it's a question around, do we break through resistance coming in the format of 45073. If we break through that and we hold above that sustained price action to give us greater confidence that that level has been broken and we are indeed going to push onwards and upwards from here, then it will feed into that narrative. But certainly we're very clearly within a protracted multi-month uptrend here, and unless we break down through your near-term support level, which is 43759, then I expect more of the same for the Dow Jones Industrial Average. Now, in terms of the US dollar, this is a really interesting one. We did a webinar this week, myself and Timothy Kyrie out in Kenya, and we were talking about, is this the bottom for the US dollar? He didn't think it was. I think there's a chance it is for the near term, because part of the narrative around why the US dollar is so weak is because there's this idea that the US dollar has burnt its bridges with countries around the world with these awful Liberation Day numbers, blah, blah, blah. Well, the tariff war has essentially done its job because he's striking deals left, right, and center. And the more deals that come across the line, the more that we're seeing people less fearful around this flight away from US assets. And so the US dollar, to me, looks like it is in a really interesting area of support. You can see here on the weekly time frame coming into trendline support, now having broken up through that first swing high, which is at 98.496. So do we bottom out from here? Now, I think one area that could potentially drive down the US dollar at the back end of this year is when we start to flip towards being more dovish, or the Federal Reserve. I'm not part of the Federal Reserve personally, but that is a potential narrative as you see those interest rate differentials and expectations start to come into play, and yield differentials. Now, that points towards potential weakness down the line against the euro in particular, as the ECB is probably going to stop easing soon enough. And therefore, when with the Fed are easing and ramping it up, it points towards potential weakness for the US dollar against the euro. But nonetheless, we're not quite there yet. We've still got a little bit of a weight on our hands. And therefore, it's worthwhile noting that for the near term, there is a chance that we could see the bulls coming back into play, certainly as trade deals are struck. If we're looking in the context of the data that's coming out at the back end of this week, of course, if we see data that points towards near-term rate cuts, be it a sharp rise in terms of unemployment, be it weak inflation data, then you're looking at the possibility of weakness when it comes to the US dollar. But, for me, I think the fact that we've broken up this 98.496, I think it's been such a crowded trade that we've now got this sort of inverse head and shoulders formation. I wouldn't be surprised to see a little bit more of the same, really. So keep an eye out on this intraday trend. More recently just come into this very deep retracement here. Is that 76.4? Yep. So 76.4 retracement and popping up through that prior high. So interesting intraday counter trend here, very much a counter trend, but we've now at least broken through that swing high that signals the possibility of gains to come. And certainly if we were to come in with elevated inflation data, and bear in mind that CPI report did provide us with some initial signals that we are seeing inflation coming from those tariffs, and the fact that tariffs are here to stay, right? So it's not that these trade deals are bringing tariffs down to zero. We are still seeing elevated levels of tariffs in play. That points towards the possibility of inflation coming into the fore. And until we see the Federal Reserve say that they're happy to move and look beyond that inflation, that provides the basis for a potential resurgence, as you see the culmination of patience on the central bank easing coupled with trade deals that appear to be getting across the line. And just this week, we've got US-China trade talks out in Stockholm as well. So the possibility of further positive stories around that as well. I hope that's been useful. Again, it's an absolutely massive week. Quite frankly, when you're trading the likes of the Dow in the week where Apple are reporting their earnings, you're going to see major volatility off the back of that as well. So keep an eye out for that. I hope this has been useful. Make sure to like, subscribe, share this to other people you think might find it useful. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.